You've probably heard private equity tossed around in movies or the news, and it sounds exclusive and complex, but it's actually pretty simple. Imagine a company that isn't on the stock market. These are private companies. Private equity firms pool money from investors to buy these companies or even take public companies private. They usually buy the whole company, not just a few shares. Their goal? Make the company more valuable. Think house flipping, but for businesses. They spot untapped potential, make big changes, and aim to boost the company's worth. The money comes from limited partners, wealthy individuals, pension funds, and endowments, managed by general partners, the experts running the show. GPs earn a management fee and a cut of the profits, known as the 2 and 20 model. Private equity isn't about quick stock trades, it's a long-term game. Firms hold companies for several years, working hands-on to transform them. They're not passive, they get deeply involved in strategy and operations. The end goal: create a more valuable company to sell for a big return. The first move is the buyout, finding a company with hidden potential and acquiring it. Private equity firms do deep research or due diligence to make sure it's a solid bet. Buying a company is expensive, so they use a leveraged buyout or LBO, lots of borrowed money like a mortgage. The company itself takes on the debt, not the firm. This leverage can supercharge returns. If the company's value rises, the firm's profit is huge compared to their initial investment. But it's risky. Heavy debt means the company must perform well to cover interest payments. If things go south, the company could face bankruptcy. It's a high-stakes gamble. The firm bets it can improve the business enough to pay off the debt and make a big profit. The pressure is on to boost performance and cash flow. Success means massive returns. Failure can mean disaster. That's the private equity risk-reward equation. Once they own the company, private equity firms get to work creating value. They bring in new management, upgrade technology, and streamline operations to cut costs and boost efficiency. Every part of the business is scrutinized for improvement. They might centralize purchasing, invest in better equipment, or renegotiate supplier contracts. Growth is key too, expanding into new markets or acquiring smaller competitors to build a bigger, stronger company. The focus is on increasing EBITDA, a measure of profitability and cash flow. Higher EBITDA means a more valuable company. Every decision is about maximizing that number. The firm's hands-on approach is all about making the business leaner, faster, and more profitable. It's transformation with a clear goal, a lucrative exit. After years of transformation, it's time for the exit, the big payday. The firm looks for buyers willing to pay top dollar for the improved company. A common exit is selling to a strategic buyer, a bigger company in the same industry. These buyers pay a premium for growth, new markets, or eliminating competition. Another route is a secondary buyout, selling to another private equity firm with a new strategy, or they might take the company public through an IPO, selling shares on the stock market. Each exit aims to maximize the sale price, pay off debt, and deliver profits to investors. The exit is the ultimate test of the firm's strategy and value creation. Success means big rewards for the firm and its backers. That's the private equity cycle: buy, improve, sell, repeat. So, what's the impact of private equity? The debate is fierce. Supporters say private equity saves struggling companies, creates jobs, and drives innovation. They inject capital and expertise, making businesses more competitive. Critics argue the debt and cost-cutting can lead to layoffs and even bankruptcies. Sometimes the focus on quick profits hurts workers and long-term growth. The industry is evolving, with more firms considering environmental, social, and governance (ESG) factors. Impact investing and responsible business practices are on the rise. The future of private equity is a balancing act, profit versus responsibility. How firms use their power will shape economies, jobs, and industries. The challenge: create value for investors and for everyone else too.